Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Trevis. This program is sponsored by OTG Capital, which is my investment trust. We do this show as a matter of a public service, I guess, all about financial education. As I say, it's about finance, money, and investing. But given the requirements of the Community Radio Network, we go out via the Community Broadcasting Association of Australia, and we are picked up by another 15 radio stations. And every so often I'm going to say hello. So I'm going to do my first one today to 2UNE, Tune FM 106.9 in New South Wales. Thanks for listening in. And we do occasionally get emails from them as well. So this week, I'd like to welcome back to the microphone only because Kirk's end has technology issues, so we have no camera there. You'll have to be stuck with my ugly muggins for today's interview. But Kirk Wilson is a subject matter expert from the Institute of Financial Professionals of Australia. Now, ladies and gents, you'll be very familiar with IFPA. They come on the show quite a lot. And the other really nice thing is that because of the very educational nature of what we talk about in finance, money, and investing, the Taxpayers Association actually uses this content for tax agents around Australia. Now, IFPA have roughly 4,000 members who are tax agents. So you may understand that one of your accountants may actually be a member of IFPA. My accountant actually is as well. So look, Kirk's agreed to come on this on the talk today. What we're going to be covering off today is the budget capital gains tax changes. Now, this is monumental what's occurred. So without further ado, I'd like to introduce you to Kirk Wilson. And Kirk, maybe do a bit of an entree for the listeners and viewers what this whole budget process has been like and what these CGT changes that are proposed are going to look like.
Well, Ray, the first thing to say is that this is probably the most dramatic and significant budget in decades, if not ever since Paul Keating first came along and did some massive tax changes. And as everyone knows, there was a lot of speculation, and as everyone should know, that it was apparently directed towards hopefully addressing inequality, and particularly in relation to housing prices and how hard it is for the younger generation to get in. Whether it does that will be a test of time. But there's so much to say about it. It's a question of getting a few things right. So I'm happy to get started whenever you are, Ray, with some questions. The key thing is, of course, what we discussed today is not tax advice in any way. And you would have to see your own advisor in relation to these proposed changes. There hasn't even been a consultation process begin. At the moment, it's a lot of toing and froing in the media, no doubt as the government sort of juggles for the right position and may get ready to walk back a few things, but who knows?
I guess you make a very valid point, Kirk. One of the interesting things, one of your colleagues, Natasha Panagis, who came on the show regularly to talk about superannuation. And a couple of years ago, we were talking about the taxing of unrealised gains. And I guess I amused lyrical with Natasha at the time, saying, it was such a ridiculous notion and it was subject to consultation that it was such a dramatic change that I never ever saw it potentially happening. Now, I don't know whether all of these particular changes are potentially going to go through and get royal assent and pass through Parliament, but let's cover off the first one. So from 1 July 27, so that's not this year, this is July next year, the 50% CGT discount for individuals, trusts and partnerships will be replaced. Kirk, what are they going to be replacing it with?
The essence of all of that, Ray, is that in effect, the government has proposed to grandfather capital gains that are entitled to not the assets, but capital gains that are entitled to the 50% discount. From 1 July the 27th next year, you will not be able to get the 50% CGT discount on gains that accrue from that time. You'll be subject to a new regime of indexed gains and the 30 minimum tax rate on the calculated assessable gain that accrue from that date. The best way to explain this, Ray, is that for assets, there are three basic rules. For assets that are bought and sold before that key date next year, the 1st of July 27, you will be subject to you'll be entitled to the 50% discount still. There'll be no changes. And that gain will then be included in your assessable income and taxed at your relevant tax rate, marginal tax rate. For assets that acquired after 1 July 27th next year, the new regime will kick into place. That is, your capital gain will be measured or ascertained by reference to the old inflation-based indexation, which Paul Keating introduced many years ago. And in addition, the assessable gain was subject to a 30% minimum tax rate to make sure that they get a sufficient amount of tax revenue from this measure. The difficult position, or the more, not difficult, but the more involved position is where you own an asset that straddles that 1 July 27 date, where you've acquired it before the 1st of July 27 and you dispose of it after that date. That is where the complexity comes in. And the key point there is that the government will still give you the discount up to the market value of your asset on that day, and thereafter indexation will apply and the 30% rate will apply. So it's sort of like there is a sort of a precedent for this, where when they denied the capital gains discount to foreign residents in 2012, they in effect allowed them to continue to get the benefit of the discount up to that date, and thereafter it was denied. Well, this is a similar measure. But there are going to be a lot of complexities, and as always with difficult things, there's a lot more questions than answers. But that's the essence of it. Now, there's one important carve-out. For new builds, they will still be entitled to the 50% discount, or you can choose indexation and the 30% rate. Now, what's not entirely clear, whether that only applies to new builds that are built after 1 July 2027, or whether it applies to ones that you might have acquired beforehand or prior to that date, which you'd be a bit annoyed if they carve out ones acquired before 1 July 27th and you're automatically put onto the indexation method. So, and here's an important point too. What do they mean by new build? Well, it includes where you put a new house on vacant land, or it also includes, it doesn't include a knockdown rebuild, except the knockdown rebuild where you put more dwellings on the land than you had originally.
So a subdivision, for example.
Yeah, subdivision, that's right. It still says to me that there's a bit of exploitation for somebody who might decide to do a knockdown rebuild and build themselves that big spanking brand new home, which with CGT free, and then still be able to get the benefit of the discount on the new dwelling next to it. But yeah, so that's about it, Ray. And I think it's very important to realise, to take this back a step, to understand why the discount has been attacked. When Peter Costello introduced the discount in 1999 and he pegged it at 50% of your capital gain, there was a bit of outcry, but it was basically welcome. But one thing people forgot was that it not only replaced indexation, but it also replaced the thing called averaging. When you worked before 1999, when you worked out your capital gain, you worked out the gain after inflation, and then whatever that gain was, to ensure that, or to more or less try and ensure that you weren't taxed on it at a higher rate when you put it in your tax return, in your normal income, they sort of averaged it out so that you'd be taxed at more or less your normal rate, or not an adversely higher rate. And many people point out the 50% discount was pegged at that higher rate to compensate for the loss of those two concessions, indexation and averaging. And also, Peter Costello said he wanted to encourage economic activity, buying and selling of shares, businesses, turnover of stuff. And in some accompanying capital gains changes to the foreign residents, it was actually stated in the ledge that this was the object. So there was still that object. I suspect they didn't see the unintended consequence of it so much going into housing, because negative gearing and the capital gains tax discount were a very powerful combination to make investing in housing very attractive, which brings us back to the reason, or one of the reasons why it is now being looked at. And of course, the revenue from the discount, the foregone revenue, no doubt was a consideration also. And these changes are, so they say, addressed at predominantly the social issue, but no doubt the revenue one will be significant too.
Yeah, it's a fascinating point you make, Kirk, in that a lot of people seem to forget it's not just about housing. And one of the things that I've seen on the social media streams that come across my desk through places like LinkedIn. I'm not a huge Facebook user these days, but I think what's fascinating is that there are a lot of entrepreneurs coming out now and saying that this measure is going to stifle innovation and stifle startups because it's going to punish those that are out there risking capital and I guess nobbling any potential gain through capital appreciation of an entity that you may go to list. So in the old days, say an Atlassian or a Canva that went to market. And ladies and gents, don't forget, this also applies to if you borrow money to buy shares, for example.
Exactly. That's an important point, Ray.
Yeah.
While the proposed negative gearing changes only apply to real estate, the CGT discount changes apply to all assets that are subject to capital gains tax. And that's really significant. And on your small business point or business people, yes, there is an issue of whether it's going to discourage business investment, but it should also be noted there are existing provisions in the law, the tax law, that do provide concessions to startups. And in relation to the selling of small businesses, those small business concessions have remained untouched, although some people think there should be greater access to them by changing thresholds. But suffice to say, the first step in calculating your gain that's exempt or partially exempt under the small business concession is working out your discount or which will now be subject to indexation. So, or will be from the 1 July 2027. So those are important considerations too, Ray. But the big one is like how the tax officers is going to deal with this key issue of where an asset is owned both before and after that key date next year. And that, as I said, there's a lot of questions raised than answered at this stage, although a few have been answered.
As unintended consequences is one of those things. It's unintended. So look, we're at about half time now. You'll hear on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone today Kirk Wilson, who is a subject matter expert from the Institute of Financial Professionals of Australia, or IFPA. And we're going to take a short break and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. This show is sponsored by OTG Capital, and today I'm really pleased to have at the microphone Kirk Wilson, who is a subject matter expert from the Institute of Financial Professionals of Australia. And we are here talking about post-budget analysis and the changes that have now occurred or are being proposed in the capital gains tax and negative gearing sphere. Now, Kirk, before we went to the break, we were talking about, I guess, the loss of the 50% CGT discount. And within the budget papers, the government very kindly provided an example of Jane purchasing an asset in July 22 for $800K. And they go through the workings and explain the differences. I guess, like most legislation, there are always unintended consequences. I'm curious, Kirk, from your perspective, does that help or hinder the understanding of the proposed changes?
Well, that example in the budget is very illustrative of a couple of key issues which have sort of been answered and sort of not been. And it's that difficult situation where you've got an asset that you've owned that straddles that key date. You bought it before 1 July 2027 and you've sold it after that date, and you're going to get the discount up to the market value on 1 July 2027, which begs the question of how you determine market value. There's probably a lot of valuers out there who are going, wow, business is going to be real good. But there is an ATO policy at the moment that if you have to get a market value, that you don't necessarily have to get especially of real estate, you don't necessarily have to get a professional valuation, although it helps in complex cases, but you can rely on comparative values. Now, that's the ATO policy. But the point with that is, if your valuation if the commissioner challenges your valuation, the onus is on you to show that your valuation is better than commissioners. And this is this problem that this arises, that this illustrates. How do you determine market value in that case? The ATO is also, the budget also said that there will be a formula or guidelines issued by the tax office how to calculate proportioning the gain before that key date and the gain after that key date. So that is still up in the air, but the key point is, what is the market value on that 1 July 2027, because you'll get the discount up to that point. Now, there's another thing to bear in mind, is that you don't realise this capital gain until, say, you sell the asset after 1 July 2027 in, say, 2030. It's at that point that you realise the gain, or presumably you will. It's then you have to account for it. You won't have to account for it on 1 July 2027 by reference to market value, because for a start, you haven't sold it and you won't have the proceeds. Now, that will then probably require issues of going back to work out market value and those type of things. So this is where it may get difficult from a practical point of view. But there's another key issue that's associated with this fact that you've got the gain accrued before that date and the gain that goes after that date, which is subject to indexation. And that is, and it hasn't been spelt out anywhere or touched on, is how you're going to allocate any capital losses. Now, that's a key one. Are you going to be entitled to bring all your capital losses to the discount gain? Do you spread them proportionally across both gains? And if so, how? And of course, in most circumstances where the gain is going to be bigger under indexation, well, you'd like to shift them to the index gain you've calculated rather than the discounted one. Presumably, depending on, nothing it will depend on the circumstances. But that issue of how you allocate capital losses is a big one, and no doubt will be one which many advisors will be turning their mind to, because it is very crucial. It has a big effect on what your ultimate net gain is, and whether you're entitled to the 50% discount on it, or whether some of it's shoved to the new rules. So it's a key point.
It certainly is. And I guess one of the key elements around that and the pre-1985 ruling as well is the end of capital gains tax grandfathering. Can you explain to the audience a little bit more about that?
That is really crucial. It was a big surprise. Grandfathering of assets of CGT assets was one of the significant features of the CGT regime when it was brought in September 85. In other words, the capital gains tax rules only applied to assets you acquired after that date. So for many years, and still even today, there's a lot of assets that are carved out of the capital gains tax rules because they're acquired before the 20th of September 1985. Now, that was a bit controversial. There are measures in the Tax Act to bring them into the net if there's been sort of changes in sufficient post-CGT changes in things. But now the tax law is going to say, or the budget has proposed, that these assets are going to be brought into the CGT net as of 1 July 2027 at their market value. So there'll be no grandfathered assets. And by the way, grandfathering is a really interesting term, because a lot of people say, well, that really means the new measures only apply to prospective purchases or prospective things. Old things are carved out of it. Well, that's true, but it also meant that those type of old things were carved out of it, and they would progressively die. They would progressively just cease to exist, like a grandfather, But with capital gains tax, there's still quite a few pre-CGT assets around. So look as though the government has bitten the bullet, and the Treasury officials no doubt will like it, and decided to bring all pre-CGT assets into the net at their market value. Now you ask, where is this going to affect me adversely? Well, I can think of one right off the top of my head. And the rule that when you die, and your home can be sold CGT free within 2 years, subject to ticking a lot of other conditions, that 2-year sale rule also applies to pre-CG dwellings. Well, given that pre-CG dwellings are no longer going to exist after 1 July 2027, they will not be entitled to that, presumably will not be entitled to that sale within 2-year rule, albeit any capital gain will be calculated by their market value at the date of death. Now, I think that's really important matter for those crucial inherited asset rules.
I totally agree. And I guess as we're rounding out the discussions, the elephant in the room, self-managed super funds. What's happening there?
Yes, I searched high and wide in the papers, and self-managed super funds are not caught by these measures. The current 33 1/3% discount will continue to apply to them, and it looks as though they won't be caught by the negative gearing measures either. So self-managed super funds are still carved out and for the benefit of retirees, and that is a good move in every way, I presume. But you never know what the future may hold.
Well, I got to say, Kirk, as an SMSF user myself, the thing that, again, it's a little bit of a quandary. And as we say, none of this is legislated yet. It hasn't gone for royal assent, hasn't even been consulted yet. And yet I find that this is, I like the valuers, are going to see this uptick of business. I think there's going to be this surge of interest in self-managed super funds, and to buy property within an SMSF, it's very complex, ladies and gentlemen. There's something called a limited resource borrowing arrangement has to be entered into. There's a whole range of legislation around it. It's not simple. And I'm curious as to, yet again, whether the unintended consequences have been thought through on this or not. Do you have a particular view on that, Kirk?
Look, Ray, I think the key thing is, we've stressed at the beginning, none of this is legislation. And even in the normal process, they release draft legislation. We haven't even seen draft legislation for comment or anything. It is still going through the to and fro-in. It will eventually come. The public debate will determine what extent things are walked back, or what are issues, or what things will change. But we have not seen anything yet. But some fundamental matters won't change. But the SMF one looks as though it won't be touched. But as we know at the moment, as we know with SMFs, it's a big pile of money in superannuation, and both sides of government have in the past expressed interest in getting more revenue out of it. So
it's a $5 trillion nest egg that keeps on growing.
Exactly, and that is both a brilliant thing, and it brings its own peculiar problems. Now, Ray, let me finally stress again on all this, as you understand, is that this is not tax advice, what we discussed today. We can't even give tax advice, because in some ways we're poking at not thin air, but something that's not quite of substance yet. But nevertheless, it is still probably worthwhile at some stage to have a chat to your advisor about what may be coming in the pipeline and what may be best for you to do. So there's a plug for your local accountant and tax agent.
You make a great point, Kirk. And I think one of the best pieces of information we can give to our listeners is, don't react too quickly at this point in time. None of this is legislated. None of this is law yet. And I just recently had the CEO of the Australian Shareholders Association, Rachel Waterhouse, on the show, and she expressed the same view, saying, Ray, there's a lot of consultation has to occur before any of this, goes through and gets royal assent. And she, from a shareholder's perspective, and given the ecosystem and the advocacy group that she represents, together with your own, Kirk, when you think about all the tax agents that IFPA represents, there's a lot of people out there. I think not just concerned. I think you made a very good point at the very start of the broadcast as well. This is probably one of the most fundamental, rudimentary changes to taxation that we've seen in probably 25 years. I don't know about you. I think it's incredibly long overdue. There's been a lot of people scared of it. So I think it's good that we've got it out there and there's debate occurring. Is it all right? Probably doesn't sound it, but Kirk, I think it's a good starting point, don't you think?
I do, and I don't think the fundamentals will change, but the politics of this had a lot to do with its introduction. But albeit there were bona fide economic and what's the word, intergenerational concerns. It will be interesting to see to what extent those same factors have a play on any changes. But I can't see some of the fundamentals changing. There just may be a lot of key tweaking or key walking back of maybe adverse things that, and when I say adverse, I mean adverse politically also, So well, I don't think we'll see changes in the fundamentals. And I do agree with you, Ray. On the face of it, it looked as though it was a change that was needed. But I do put the proviso that 50% discount compensated for both the loss of indexation and averaging, and we haven't had averaging introduced. On the contrary, we've had a minimum rate of tax of 30% introduced. And whether that applies to a net gain or just the raw gain is another one of those issues that has to be resolved.
Yeah, I think they're very good points, Kirk. Look, Kirk, thanks so kindly. It's time for us now. We're at the end of our show. You've been on Dollars and Making Sense, a weekly show about finance, money and investing. Kirk Wilson from the Institute of Financial Professionals of Australia. It's been a real pleasure having you on the show, and we welcome you back again in the near future. Yes,
sure, for sure, right? Well, maybe when a few of these things become more concrete.
Yeah, I think that's going to take a little time, that's for sure.
Thanks again,
Thanks again. All the best.
Bye-bye.